at Amazon, the company that I work for, we operate our company on what we call our 14 leadership principles. And if you're not familiar with Amazon and how we work as a company, I encourage you to go Google those things, the Amazon leadership principles. It'll go to a webpage that's on our site that talks about them. One of those things, one of those 14 leadership principles is think big. Make big, grand plans. Make big bets in life. But also have a bias for action. And I think that was the point that was trying to be made in the panel, which is it's okay to dream big. It's okay to think really big about things, but also have that bias for action. Go reach out for things and be reactive and be nimble. You heard nimble come up a lot in the panel. And one of the ways that we talk about nimbleness in business today is agility. And we talk about the lean startup and companies looking to be nimble. You heard that repeated throughout, that FinTech startups are nimble. They have the ability to move and shift and change, more so than large financial institutions do. And really, if you don't remember anything that I said today, that's what this is all about. Large institutions not being able to be as nimble or agile as smaller ones who are really changing the way the world works. And they're using new tools to do that to meet customer expectations. The last thing I'll say about this is, if you don't do anything else and you're a student, just remember this: embrace technology. Everything that we do as a society going forward is going to be in some way linked to technology. I'll tell you about my job. I started my career as a trader. Coming out of school in 1998, I started as an equity trader. And I immediately got introduced to all the different trading systems that I would be using. I started as an Instinet trader, if you remember Instinet trading if you're in the room. And had to interact with things like an Instinet terminal and then a Bloomberg terminal. And then I moved on into compliance roles where I was using, you guessed it, technology to actually make sure that what we were doing was safe and secure and sound. And then I moved on to running some businesses for an exchange company called NASDAQ, where you guessed it, everything that I did as a financial services professional involved technology. Our matching engines, our trade reporting facility, the different risk systems that I was responsible for selling to people. And I moved to JP Morgan, where I was responsible for trade surveillance solutions, which again was technology, taking all of the different orders and transactions that JP Morgan did and making sure that we were safe and sound. And then I got asked by this company called Amazon to come and help them really help the financial institutions of the world, whether small fintech companies that are just getting started or the largest in the world, embrace technological change and to use new tools to really affect that change for a new world. Because we live in a new world, right? This is really an unprecedented time in history. Now more so than any other time in the world, consumers, and not just financial consumers, but all consumers, and especially financial consumers, as you heard the panel talk about, have more choice than ever before. I love the fact we took a poll about checks and cash and credit cards and cryptocurrency. That's amazing. Think about it. When I got out of school, basically you could write a check or you had a credit card or you had cash. None of the things that we talked about from the standpoint of Venmo or Zelle even existed or had been thought about. That's really cool. It's really exciting. So I've been asked to talk about what's powering this change today. And I'll spend the next 2 hours, no, I'm kidding, because I know I'm standing between you and your Friday and probably you and cocktails as well. So I'm going to take about 45 minutes to an hour and talk about really what is driving a lot of this change. And it's technology. I'll just bury the lead. It's technology. It's what's driving this change. And it's really what's driving change in the world anyway. And I think before we start, we should probably level set on some things and expectations, because really we're all biased based on our own expectations of the world. I'll use this as an example. This is my friend George Jetson, and you'll see why in a second. This is an article from some years ago that talks about why the web will not be nirvana. This says, visionaries see a future of telecommuting workers, interactive libraries, and multimedia classrooms. Do our computer pundits lack all common sense? I think you all go to NYU, or some of you go to NYU, so you know that some of this is possible today. Many of us probably telecommute on a regular basis. I know that part of my staff do. Here's a second piece that I really love coming from the company that I work for. We're promised instant catalog shopping, just point and click for great deals. Yes. And then lastly, we'll order airline tickets, make restaurant reservations, negotiate sales contracts, and even if there were a trustworthy way to send money over the internet, which there isn't, the network is missing a most essential ingredient in capitalism, which is salespeople. This was written by a guy named Cliff Stoll in Newsweek in February of 1995. I remember 1995. I just got out of high school and gone to school at Texas A&M University, where I went to school in Texas. This was reality in 1995. Think about reality today. All of these things happen, and we do it without having to think about it. That's the power of technology. One of the other interesting things that happened in 1995, which I think Cliff would find ironic now, is that this company was founded. And so a lot of the things that he talked about in his piece in Newsweek in 1995 were actually addressed and solved by the company that I work for. In 1995, these things also didn't exist. And the reason that I put these things on the slide is that these are things that I use pretty much on a daily basis. Does anybody not use these things? Not a hand goes up in the room. Good. These things are driving change, especially the one in the right over here on the right. This week is a huge week for this thing. This thing has its 10th edition coming out. And this is driving more change from a platform perspective, from smartphones and tablets than anything else on the planet. These things also didn't exist in 1995. And if you're not as familiar with the financial services industry, these are kind of major moments or things that have affected the industry over the last, really, 20 years. PCI compliance, the financial crisis that was mentioned earlier, the Dodd-Frank Act, the flash crash of 2010, Basel III, market access rules all about protecting customers, and then things like the Consolidated Audit Trail that are impacting the industry and really all tie back into technology. And so my first statement to you is something I will continue to encourage you to think about. Remember that anything that you do in life is going to be impacted and affected by technology going forward. These things also didn't exist in 1995, and it's kind of an eye chart, I know, but this is a chart from CB Insights that really kind of does a breakdown of the digital banking market map, and this is actually a little bit old, but it goes to the point that the world is changing, and it's being changed by customer expectations. As consumers, we expect more. We live in a consumer-driven society. I think somebody mentioned earlier, people expect money and investing to be like Amazon. I really appreciated the compliment. I hope it was meant as a compliment to my company. People want to be able to access things very easily. And I think there were some people from Betterment here earlier today, and I'll talk about some of these other examples of companies that are really changing the industry. But what's happening is that these new entrants are changing the industry based on customer demand. At the same time, the guys that were on the stage earlier, MasterCard and JP Morgan and established organizations aren't sitting lightly. They're also stepping up and reshaping the industry too. And they're using technology to do it. These are some companies that are actively engaged and really transforming their entire business to meet the demands of consumers, whether their customers are enterprises or direct financial consumers as well. So I'm just going to pause and give you maybe a quick snapshot on really what's going on from the standpoint of technology adoption in financial services. The industry that I work with a lot in my role and what I do at Amazon Web Services is I'm responsible for business and market development in the financial services industry. I told you about my history. I started my career as a trader. I did that for about 10 years, and then suddenly I realized that since my name was not Dell or Hewlett-Packard, that I wasn't going to be able to be a market maker because electronic trading was really the future of the industry that I loved and got into the industry to do. And so I very quickly pivoted into a role in compliance and used my expertise in trading to actually build a career in surveillance and transactional compliance in clearing and execution. Technology has driven the majority of the changes in the financial industry over the last 50 years. In the last 20 years, it's really accelerated a lot of the things that we've done specifically in capital markets and then in payments as well. But now more so than ever, you're seeing large financial institutions really embrace things like cloud to drive the industry much more forward. You don't get to hear a lot about it in the news. It's not necessarily widely reported yet, but I thought I'd give you a snapshot into really what's going on today. Right now, we have a top 10 bank in the US that's moving to really get out of the data center business. This particular organization owns 8 data centers around the nation today. They're going to go from 8 down to about 2 or 3, and they're going to try and actually reduce that footprint even more as they go forward. We've got major insurers that are performing actuarial calculations that used to take them days to do, and now they're doing them in minutes based on the fact that they can harness large amounts of computing power from us to do that. They're also saving millions of dollars in the process of doing so. FINRA, who's the primary regulatory agency for the capital markets industry in the US, loads 35 billion market events into Amazon S3, which is our simple storage service, to run surveillance on US capital markets every single night. That's 35 billion rows of information that they pump into AWS and then analyze to make sure the markets are safe and secure. And then we have people that are asking Alexa, which if you have an Amazon Echo at home, yep, a few of you, you can ask Alexa, hey, what's my Capital One credit card limit? Or how much did I spend at Home Depot with Capital One last month? We actually use that as a demo when we're demoing the Amazon Alexa engine and the Amazon Echo for financial institutions. And we've also got people who can ask Alexa for a stock quote from Fidelity. In the future, you'll be able to ask Alexa for an update on the market, perhaps, or to give you recommendations on how to hedge against Brexit, or to ask Alexa, hey, how's my portfolio doing today? And is there anything I need to rebalance? These are all things that are possible with technology today. And then lastly, you've got a number of the largest asset managers in the world really moving everything they can towards the direction of cloud to be agile and to be nimble. You've got people that are consolidating data centers. You've got people that are shutting down their own operations where they've built and run their own technology for a large period of time. They're moving really mission-critical things like order routing systems, core banking platforms, insurance platforms. All the things that make the industry move are being modernized as we speak today. And then we've got a lot of leading providers in space, and so people that provide systems and technology that make the industry go, like a First Data who is here, I think. Large organizations like that are beginning to move their applications as well as they serve their customers that are in the cloud. So in a nutshell, right now the industry is changing. And I really like the way that the World Economic Forum phrased this, not last year, but 2 years ago, because they phrased it as the Fourth Industrial Revolution. And if you're not familiar with those things, the first one was obviously steam power and mechanization. The second, obviously, electricity. The third, the introduction of the microchip. And today's revolution is about digital. It's all about moving to digital with cloud, with IoT, and a focus on platforms. Many people think about fintech and they immediately think of the word disruption. And they also probably associate the word disruption with something that's not good or unpleasant or painful. But really, disruption is just change. And change happens all the time. And this is just an illustration of some of the changes that have happened in technology over the last 40 years. And you can see with the beginning in the 80s with the introduction of personal computers, all the way up into the 90s with PC networks and enterprise-grade software, into the early 2000s with cloud applications, and now into the 2020s where platforms are key. Evolution and disruption are just the norm. Change is the norm. It's only accelerating. And that's what's unique about this wave is that it's accelerating and it's now focused more so on interactions between society. This is a really hard-hitting slide for all of my enterprise customers when I go in and talk to them. Typically, those are organizations that are large banks or insurers or trading firms, and it's really a bit of a dose of reality. The world doesn't work the way it used to when those companies were established. The world doesn't work the way it used to when those companies were actually growing at very large rates. the world's a much different place. The first statistic is probably the most telling, that the average lifespan of an S&P 500 company dropped from 67 years in the 20s to just 15 years today. That used to be a benchmark and a bellwether, and now it's just a blip of time. 2/3 of IT budgets today go to just keeping the lights on, or BAU, business as usual as we call it, in large enterprises. That means most of the things that you spend money on are just the status quo, not on innovating, not on improving customer experience at a large enterprise. And then we talked a little bit about security and concerns about security. 77% of CEOs today believe that security risk has increased, and I would agree with them, given what we've seen in the marketplace over the last couple of months and year. But change isn't always bad. This change has actually also enabled us to have a major shift in focus. And you can see along the line, they all kind of build on each other. You've got innovation at scale that's possible now, the ability to actually do holistic analytics, things like AI and machine learning that are at the top of the bar. Those things are really only truly possible when you have access to two things: lots and lots and lots of data, and the ability to store that data, and in financial institutions in a very safe and secure way. And then second, the ability to analyze that data with lots and lots and lots and lots of computing horsepower and tools. And that's what we're providing to companies today. Let's talk a little bit more about this change and what's driving it. Risk. If you work in a financial institution, in some way, shape, or form, you are dealing with risk at all times. And the panel hit a little bit on that as well. But new forms of risk continue to emerge every day. We've also got data that's revealing both new opportunities to go to market as well as cost-saving opportunities. Most of the people that come to us for help with analytics are coming to us for help in two ways. Number one, they have a compliance obligation. They say, Scott, we've got to keep 7 to 10 years of data, and we've got to be able to pull it back and give it to a regulatory agency at a moment's notice. I need help being able to store that and analyze that quickly so that I'm not found to be out of compliance with regulation. Okay, we can help you there. The second thing that we get asked about the most is, Scott, I've got lots and lots of data that I've got to keep for compliance purposes, but I would imagine that in all that data, there's something interesting that I can maybe turn into a new product. Or there's some insight that's going to make my business better, but I don't have the ability to actually go through all that information and organize it and analyze it and find those business insights. And that's something that we're actively helping our customers do as well. And then lastly, something I mentioned at the start, today financial consumers really have more choice and also higher expectations than they've ever had before. These are some of the areas where we're seeing change in the financial industry. High-performance computing, both for market risk as well as other forms of risk, like credit risk, and calculations like actuarial calculations, are able to be done in a fraction of the time at a fraction of the cost. That's real dollar savings and real time savings for organizations. We've got disaster recovery and business continuity that's actually been able to be thought about in a much different way. Before, if you're large institutions like a MasterCard or a JP Morgan or a NASDAQ, where I used to work, you had to have a data center and another data center and maybe another data center. Or perhaps you had your own data center and then you had a co-location facility or a disaster recovery facility like at a SunGard or some other company that said, yes, we'll provide you that place to recover if something happens. Today, with cloud technology, you have the ability to be disaster resilient, first and foremost, not just be able to recover from disaster, and be able to stand up applications in different parts of the world within minutes. So if something were to happen to your primary facility on the East Coast, you very well could stand up your entire infrastructure in a matter of minutes on the West Coast, depending upon where your cloud provider had a region. Last year at our big conference that we call AWS reInvent, we actually did an exercise where we built a stock exchange on AWS, simulating what we've done for one of our large stock exchange customers, and we actually tore it down as if a disaster had occurred here in New York and rebuilt it on the West Coast. It took us 7 minutes to stand the entire stock exchange back up and to rebuild the order book in our example. The reason it took 7 minutes is because we actually wanted to have a human being have to make a decision in the process. If we hadn't had to have a human being make the decision to fail over to the new data center, it would have taken us 3 minutes to bring that stock exchange back up. As opposed to today, when you stand up a stock exchange after some kind of an outage or disaster, it can take anywhere up to 3 or 4 hours, or they may just close for the day because they don't have enough time to get the exchange back up to finish by the closing bell. Data warehousing, process and analytics, machine learning for surveillance and fraud, the migration of core systems, everything is changing in the industry, and it's because of technology today. AI and machine learning is one of the hottest topics on the street today. Anybody interested in machine learning or AI? Yep, a lot of us are. It's actually in its infancy in the industry, I think. A lot of the things that are being called machine learning today are really just big data analytics in a lot of ways. I think we're just now seeing organizations really begin to move into true machine learning with things that are being offered by AWS and other cloud service providers, because you're getting the horsepower. You're getting the horsepower to actually run true models and have the machines learn. And whether you're using tools that we provide, like our Lex and Poly and recognition tools that are kind of basic entry points into AI and machine learning, or you're using other machine learning frameworks or going into deep learning, the industry itself is actually kind of at the beginning stages of leveraging machine learning in very interesting ways. And I think this is probably going to be the biggest area of growth over the next couple of years. In fact, while blockchain may be very hot and Bitcoin and cryptocurrencies are something that we like to talk about a lot and have been for a couple of years, I think this is going to be the hottest topic for the next several years because it's more readily applicable to the industry. A lot of the things that blockchain and DLT are trying to solve are in the middle and back offices. And when you look at AI and machine learning, you've got the ability to bring this technology to bear and have a much bigger and faster impact on your business as opposed to trying to really invest in DLT and blockchain, although I do think that those technologies are going to be impactful as well. AI and ML could revolutionize financial services, and I think a lot of ways it will. But with it is going to come a lot of change. And change is usually not something that's embraced very easily by large institutions. And as a society, we don't necessarily know what impact it's going to have on the way we deal with financial institutions. Today, there are people who are responsible for the advice that you get from a registered financial advisor. That registered financial advisor is responsible for the advice that he gives to you. And if something were to happen with that advice, there can be consequences for that registered financial advisor because he's registered with a regulatory agency. And his firm can be held responsible from a fiduciary responsibility for the things that happen with your assets. When a machine makes the decision, who's responsible? Because the machine isn't registered, the machine isn't held responsible. Who's actually held responsible for the fiduciary decisions that are made based on the actions the machine took? It's going to be a very interesting time over the next several years as we apply this technology and then regulation catches up to the changes that we've made. Just some of the potential impacts of AI and ML, it is really enterprise-wide. You can see in compliance, surveillance, and fraud detection, which is really where you're seeing most of the use cases happen today, specifically in financial services, document processing, being able to use OCR and other technologies to really take a lot of the human process out of taking pieces of paper and scanning them and doing things with it, as well as trading and then customer experience as well. What I want to talk about now, after kind of setting the stage, is really some of these tools, not specifically our products, but just the way people are using them and really what the advantage of using these tools are. When you think about FinTech, you need to come to the realization that the majority of FinTech companies are building using cloud technologies. This is the Forbes FinTech 50 from 2016. Every year in December, Forbes releases this annual list of the hottest FinTech companies according to them. Last year, we had 96% market share with these organizations. That means these organizations, in some way, shape, or form, are leveraging AWS's cloud to build and run their businesses. The year before, we had 100% market share on the list in 2015. There were 2 companies that were actually running on-prem in this list, which I think is an anomaly. I think you're going to find that this year's list, you're going to find them all probably running and building on cloud. Really, what are the benefits of cloud adoption for any organization, whether you're an established company like a large bank or an insurance company or an exchange or a small FinTech startup? There's really 4. The first is agility, that ability to be nimble. that ability to experiment, to throw something against the wall like you heard on the panel earlier, and to see if it sticks. If it doesn't stick, guess what? You didn't make a heavy capital outlay in order to buy infrastructure to make that experiment happen. You simply bought a couple of hours of computing instances from me or from Google or from Microsoft, and you tried your experiment, and when it failed, you shut it down and you handed it back to us. You said, thank you. And then you tried another one, and another one, and another one. This technology enables you to experiment faster and to have the consequences of those experiments not really be that great from an economic perspective. Scalability. Scalability is probably the number one thing that a lot of our large financial institutions are looking for, as well as some of our smaller ones. Being able to buy only the amount of infrastructure that you need to solve the problem that you have in that instance. One of the best examples that I can give you for this is the fact that the company that I work for, AWS, also has a large customer that you may know called Amazon.com. And every year we have an event that we call Amazon Prime Day. And Prime Day, yes. And on Prime Day, we actually get to watch Amazon.com scale. And you can imagine how that happens and just the massive amounts of computing power that go into powering something like Prime Day or something like Black Friday after Thanksgiving, and all the different needs from a compute standpoint that the organization has on that one day or those 2 days of the year. But then the next day, they don't need all that infrastructure. And so with scalability, you have the ability to turn the knob and ask for more computing power or more analytical power as you need it. And with tools like that we have, like our auto scaling, you don't even have to turn the knob yourself. The machines themselves will actually scale themselves to the appropriate level to handle the inbound request for traffic. And once it's done, they'll scale themselves right back down. We're seeing a lot of our financial institutions customers take advantage of this. And so if you have to process transactions on a nightly basis, like securities exchanges or like regulatory agencies, I gave you the example of FINRA earlier. When FINRA begins to process those 35 billion rows of data, they don't start with all the machines they need to process 35 billion. They start here. And as they scale up to meet the demands of the market for that day, so does their computing power. Leading edge technologies. I think you might, if you don't work in a financial institution today, be really, really frightened by what some of these organizations are being powered by. I had the opportunity to be in Brazil earlier this year during the summertime, and I was talking to one of the largest banks in Brazil about their transformation and how they're embracing cloud. And it was a kind of a touching story because the CIO mentioned to me that their chairman was actually the first person to ever buy a computer for the bank back in the early 60s. And of course that person, when he bought a computer, he bought a mainframe and installed the mainframe at the bank. And I told the CIO as we parted, I said, how cool is it going to be when we together can go to your chairman and tell him he can also be the person responsible for actually buying the last computer that this company ever buys for itself, rather than using scalable infrastructure from a cloud provider like AWS. Having the ability to constantly refresh your technology and use the latest and greatest, like machine learning tools, like serverless computing, which is something that we're leading with our product Lambda, that is a powerful amplifier to business. We don't have to outlay capital every 7 years because now you've had a depreciation schedule on the things that you bought. And the minute you bought them, they really became obsolete because the next iteration or the next generation of that came out. And so being able to stay on the leading edge of technology is highly beneficial. And then lastly, cost optimization. Many people think about cloud and they think, oh, it's all about cost. You're going to save me money. In fact, Ann Bowden, who's the CEO of Starling Bank over in the UK, was quoted in an article this week on Quartz. And she talked about the fact that, yeah, you're going to save money. Things that cost a bank $30 million to do today, you can do for about $30,000 on cloud. You know, major transactional processes that cost that much money and take thousands of people to do, you can do for about $30,000, so 100 times less, and you can do it with far less people. Just divide everything by 100, and you probably got what you're going to be able to do from a cost perspective as well as a people perspective. On average, in the financial services industry, we see our customers saving anywhere from 40 to 45% of their total cost on technology spend when they move to cloud. Let's talk a little bit about agility, and I'll talk about some examples because I do want to give you some real-world examples of companies that are leveraging the cloud to be transformative and to be innovative. Anybody have a Robinhood account? Or have heard of Robinhood? Yeah, a few of you. So Robinhood is an organization that provides online stock trading, and it's not even online, it's on your phone, at least today. This week they also announced that they're building a social network of their own to enable their trading community to actually interact with each other in a much more impactful way. But Robinhood is a company that, let me just give you some comparisons, today has 3 million users on their platform. They're a 4-year-old company. They started in 2013. They've transacted over $100 billion in securities transactions, and they operate the company with 100 people on their staff. By comparison, E-Trade, they have 3.6 million users, and they have a staff of 3,600 people. They've been in business a little bit longer than the 4 years that Robinhood has. TD Ameritrade, they have 11 million users. They also have a staff of 10,000. And so you can see how a company that was built 4 years ago to do the exact same things that traditional companies, legacy companies like TD Ameritrade and E-Trade do, they have the advantage. They're built in a much different way than these legacy companies are, and they're able to scale. You can see here that they've saved, at least at the writing of this, their 3 million customers over $1 billion in commissions since they launched, and they did that with just 2 DevOps resources, 2 people that were developing and operating their systems as opposed to the thousands that some of these other organizations have to do. Anybody heard of Simple? Simple Bank? Some people have. Simple is actually a property that's owned by BBVA. This is a bank without branches. It's a digital bank. I just aged myself in my mind when I said a bank without branches because that sounded really cool 4 or 5 years ago when it first came out, but it really is kind of the norm now. I mean, you can look across the world at what's happening with challenger banks like N26 or Starling, which I mentioned, or Monzo in the UK, and this is the new norm. Banking without having to walk into a building to make a transaction happen. What I love about this quote is Tom was pretty cheeky when he said it. You can read it for yourself. I'm not going to, because my grandmother's watching on TV, about what he said. But this is really true. When you take away the need to maintain your own infrastructure and build all those things, build data centers, buy the land, pour the concrete, rack and stack and power and cool all that infrastructure, when you take all that away and do that for somebody, it gives them the ability to focus on being a bank, or to being a trading firm, or to being Netflix, or to being GE, or to being any one of our other customers from an enterprise perspective who's leveraging the cloud to really enable and boost their business. Scalability. I'm going to throw a traditional business in here at you, and then I'll give you some other examples that are kind of cool from a fintech perspective. But BBVA is one of our customers who's just using our infrastructure to scale. You can see their daily transaction volumes and what they've done over the last several years, 9 million in 2006, 542 in 2016, and then well over 1 billion transactions in 2017. Being able to scale your infrastructure to meet your demands and not always have to plan for peak is super critical in today's market. We have a customer who's a fintech company called Ticker Tags. Anybody familiar with Ticker Tags? No? I encourage you to check it out. It's a very interesting company started by a gentleman by the name of Chris Camillo, and Chris wrote a book several years ago called Laughing at Wall Street. And in the book, Chris details how he took about $20,000 and using Twitter and social sentiment analysis turned that into well over several $1 million. And what Chris did every night was he went home and he read tweets about things that he was interested in investing in. One of the stories that he tells a lot is the story about how his wife really loved Kate Spade and how she really, really liked to buy things from Kate Spade. And so Chris said, okay, that might be a trend that I want to look at. And so Chris would go home and he would read as many tweets as he could about Kate Spade every night. Sometimes he'd read up to, I think he was talking to me the last time I talked to him about reading 5,000 tweets a night just to try and find a signal in the market. So Chris actually was successful, grew from around $20,000 to several million. I don't know the exact number off the top of my head, but it's in the book. And so he said, you know what, I can actually turn this into a business idea. And he started ticker tags. And ticker tags is a way for people to build libraries of tags that they're interested in, and then take those tags and compare them to what's happening on Twitter and what's happening in the market. And the example that he gave me the last time, and every time I see him, I always ask him for a new example of a way that your ticker tags and the tooling they offered provides really great insights into the market. The latest example he gave me was the Limited brands. If you don't know, gentlemen, Limited actually owns a property called Victoria's Secret. And Victoria's Secret's #1 seller for quite a long time have been their clothing for women that are a little bit more supportive, if you will, that have a little bit more structure to them. And there's a trend in fashion, if you're not familiar, that's happened this year that's actually been quite impactful for Limited brands, but not in a way you would expect. Has anybody heard the term bralette? Yes, the women are going, yes, I've heard of this. And this is a move away from more structured undergarments or things that are boosting and more things that are freeing. And before the last quarterly earnings report of Limited brands, Ticker Tags was picking up signals based on social media feeds and Twitter that sales of these new products from Victoria's Secret were skyrocketing, huge interest. And we had a new trend in fashion. And that's great for Victoria's Secret. However, that meant a downward move in sales of their other products. And when you look at the cost differentiation between what their new products were selling for versus what the other more popular products were selling for, that's a big problem from a profit perspective. And actually, Limited brands missed on their quarterly earnings for that quarter. And Ticker Tag was able to pick up on that based on streaming information in from Twitter, taking the fire hose, if you're familiar with the fire hose feed from Twitter that they offer, and then using that information and that data and analyzing it based on tags. And they were able to predict that, yes, while this is a popular product, it's actually going to eat into their profit margins because they don't charge as much for this particular product. And so it's a great use of our infrastructure to scale, taking in massive amounts of information. Just imagine the number of tweets that happen about Victoria's Secret or other brands today as you talk about the things that you like in social media, being able to take all that information in and then analyze it and find trends and signals in the market. Very powerful. You have to scale from a computing perspective. Leading edge technology. We have a customer named Monzo in the UK. Anybody familiar with Monzo? Does anybody have the pink card, the hot coral card? I don't have one. I kind of want one. I just can't get one. I'm on the waiting list. So Monzo is a brand new challenger bank in the UK. And they are completely rethinking the way that banks are built. This bank runs completely on AWS, much like N26 does, which is another challenger bank in Germany who's actually beginning to launch in the UK. I heard they have a waiting list in the UK as of this week, as well as Starling Bank and others. These organizations have the freedom today to completely rethink how they're going to build a bank or a brokerage house or an insurance company, and they're doing it successfully leveraging these technologies. And much like Robinhood, they're able to do it with far less people and far less overhead. I'll also throw in for good measure our friends at IHS Markit. IHS Markit is not a startup. They're a company who has been in the fintech space for several years, at least 30. And they're actually in the process of transforming themselves as well, building new applications in things like blockchain, building things around what the market needs, like trade cost analysis, regulatory reporting, portfolio evaluations, and then moving all their legacy applications that help power the markets today, like market analytics and market thinkfolio, and all their other prime properties that power financial institutions to the market because they know that that's where the market is moving. From a cost optimization standpoint, when you can run things at 60% less cost, it just makes sense. I talked to you about some of the numbers that we saw from our financial services customers and the average cost savings for a large institution, but for a fintech startup, it means a lot to be able to really start your company for thousands of dollars when not even 10 years ago it would have cost you tens of millions to actually get started based on the capital expenditures you had to make. And then lastly, I'll talk about FINRA a little bit. FINRA saw, as I mentioned, a 40% cost savings. So a legacy company moving to this type of infrastructure sees massive cost savings, specifically when you're using computing power for a lot of analytics. So in closing, it's all about being able to innovate faster and to do so without having to lay out a lot of money in the process. And lastly, being able to reduce risk. In financial services, risk is a topic of key concern, both from the standpoint of just managing risk with money, but also managing risk in relation to security and compliance. And being able to build a business on the cloud delivers these things to you really as a service. And we're at an inflection point in the industry where you're going to see more and more and more small financial institutions get started because it's easy to do so. And you'll see more and more large financial institutions continue to change. And so I'll go back to the thing that I told you at the beginning. If you are a student, embrace technology. If you're not a student and you're like me and you're in the middle of your career, embrace technology. It's not going anywhere. And then lastly, think big. I always like to close my presentations with this quote. And this quote is from Jeff Bezos, who's the CEO of Amazon. And he talks about the fact that we always have to lean into the future. And I like to close my presentations with a picture of the Prime Air droid, the drone, because many people thought that when Jeff introduced this a couple years ago on TV, he was being interviewed, they thought it was kind of a publicity stunt. It's not. In the UK today, my parent company, Amazon, is actually delivering packages and goods to 8 test customers in the countryside with drones. This is real. And this came from an idea that we had a couple of years ago. Because we're leaning into the future, we're leaning into our customers, and I would encourage you all to continue to do that because this industry is changing, it's changing rapidly, and I can't wait to see where it goes. So thank you for sticking around. I'm happy to take questions after this, but I know we're at the end, so I'll take them just kind of offline. I'll stick around. But have a great weekend, guys.
Thank you so much. Thank you so much. Thank you, everybody. It was really a pleasure to have you here. You guys were an amazing audience, and I'm super grateful to you for being here. And big shout out also to all the staff and everybody else who helped make this event happen. So thank you. Have an amazing weekend. Go FinTech.